Hey everyone, Couch Investor back to another video for today, and I'm pretty certain that none of you expected to see Build-A-Bear workshop on this channel. Well, in this video I'm gonna try to convince you that this is probably one of the most underrated companies and underrated investment in the markets right now. This is not a meme video or a meme company. This is a company that actually makes money. And looking at the financial metrics, it's pretty cheap today. Now we're gonna go over their earnings report, which they released September 1st. That will happen a bit later in this video. First, I will give you a quick overview of what the company actually does, how it has actually evolved in the last couple of years, because most of you maybe know this since most of my viewers come from the United States, then you've probably heard about Build-A-Bear. So first, a quick overview of some metrics that I wanna talk about. So return on equity over 57% here. Drawdown funding speak, not that much, 20%. Gross profit margin for the full year, over 52%. Now for this quarter was a bit less. We're gonna see why. Then a PE for the next 12 months, 6.4 times. Now they say here a forward PE of 5.5 times. This may be already calculating the new numbers we just got. So fairly cheap, and it is growing year over year, by the way. Then EV to EBITDA for the next 12 months, 4.8x. So quite a nice performing company at a very undervalued price, I'd say. Free cash flow positive, $20 million here and growing. Now Build-A-Bear is not just a company that just sells bears at in-store location. No, they also came out with their own subscription called Cupscription. That's how it works. You select a plan, items are created and they are delivered seasonally. So you can enjoy a new box 4 times a year. These are the prices per box, obviously plus shipping, which as we know, subscriptions are always a nice addition to a business model. Then we have hard boxes, same concept, let's say not a subscription, but a box specifically for an occasion here. So you're a peach box, so say thank you, celebrate something, wrong time, and then just many other options right here. And there are also vending machines. You might find them in airports, not that many airports currently, but you will find them in more and more places in the future. It's yes, like a vending machine for drinks and snacks, but this one will give you a bear. It doesn't cost them that much to build the vending machine. Location-wise, doesn't cost them that much either. And then the bears, well, it's either in store or now it's in the vending machine, doesn't really matter. And we know that airports are where a lot of people come in and out every day, especially tourists. And so now before we go and look at the earnings report, if you want to support this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Make sure to check out all the other links in the pinned comment as well. And I'm already telling you now, I will be adding this company in our portfolio on stockart.io. You can follow that, link is down in the description as well. It's free to follow, so why not? All right, so they start here with a quick overview from the first half total revenue. That was $218.3 million, the highest in the first half in the company's history, an increase of 17.1% from the prior year. And this included total revenues of $100.7 million in the first quarter, an increase of 6.3% year over year. And this also beat the estimations. I believe the estimated numbers were around $95 million. Now, they did miss on earnings per share, but we're going to talk about that a bit later. Now, the company authorized a new share repurchase program of $50 million following the completion of the previous $25 million, which, by the way, if I'm looking at it correctly, that's over 20% of the company's market cap from today's prices. So we've seen the total revenue. Now net retail sales were 95.9% or 5% increase year over year. Now, by the way, I'll add here some more context. So 65% of the locations are in malls today and generate around 55% of revenue. 20% of retail sales are e-commerce, and that's up from 4% back in 2015. So a huge shift there. Also a big shift away from malls, since, well, malls are slowly but surely dying. Now, when it comes to e-commerce, 70% of those e-commerce orders are fulfilled in store locations, which means Obviously, the margin you get from e-commerce, from online, will drive up the operating leverage of those physical fixed stores, which is very good. Now, they did say that consolidating e-commerce demand, orders generated online to be fulfilled from either the company's warehouse or in stores, declined 8.4% compared to last year, which they had the benefit of strong launches of key products as growth in Europe was offset by decline in North America. Now, it's very important to note that a lot of their products, more specifically between 30 to 50% of sales, come from licensed IP. So that's also a risk, because if, let's say, suddenly one of these brands does not want to work with Build-A-Bear anymore, well, the company will take a big hit. I believe we've seen that with Hasbro and Disney as well. And as I said before, gross profit margin has taken a hit. It's now 49.6% compared to 53.2% in the same quarter last year. Now, the 360 basis point contraction in gross profit margin was primarily driven by the negative impact of an increase of approximately 400 basis points in transportation cost, of course, as well as other inflationary pressures, partially offset by leverage of fixed occupancy and warehouse costs and lower promotional activity. Obviously, we've heard this before, especially in today's inflationary market. And our net income positive, as I said at the start, $5.8 million or 38 cents. Now, market was expecting 45 cents, so a little miss here. Obviously, the reason might have been shared before, like we've seen with the gross profit margin there. Now, as for EBITDA, that was $10.7 million, a $1.8 million decrease from $12.5 million in the same quarter the year before. Now, before I go and have a look at the balance sheet, it's very important to know that when you buy a bear, it's not just one single bear that costs, I don't know, $20 or so, let's say. It's you buy the bear and then you can have lots of additions to that bear. So for them, higher ticket prices, higher ticket items, let's say, keeps increasing the more things you can add to your bear. Accessories, clothing, sounds, scents, a heartbeat, you name it. So you start with 20 and you might end up spending, I don't know, $40, $50 or so on that same bear. Now, as for the balance sheet, by the way, they have no debt, right? They have no debt, but they have cash. So as for July 30, cash equivalents totaled $14.4 million compared to $51.1 million the same quarter last year. Now, why is there such a big difference? Well, obviously, share buybacks. And then by saying here, the company finished the quarter with no borrowings under its revolving credit facility. Now, what they didn't mention is this right here when we talk about inventory. So total inventory at the end of the quarter was $87.7 million, an increase of $40.4 million the same quarter 1 year ago. This is reflecting, they say, strategically planned accelerated inventory purchases intended to partially mitigate inflationary and supply chain pressure. Don't forget, second half of the year is very important for the company since those quarters are linked with holidays. So obviously sales will increase there. Now, with regards to those high inventory, the company noted that it is comfortable with the composition and level of its inventory, which supports increased consumer demand and critical seasonal products. The company continues to expect to end the year with total inventory below 2021 fiscal year end levels. When it comes to outlook, they say that with current momentum continuing into the third quarter, the company is reaffirming its fiscal 2022 guidance, including total revenue in the range of $440 to $460 million as compared to $411.5 million 1 year ago, pre-tax income in the range of $52 to $62 million, EBITDA in the range of $65 to $75 million, CapEx to come at $12.5 million at the midpoint, and to finish the year with inventory levels below those of fiscal 2021. If this gets achieved, this is a huge win. Now, we'll end by saying that there are some activist investors that have a pretty big position in Build-A-Bear and are putting some pressure on the company to either, increase buybacks to return more value to shareholders, or maybe pushing it to go private. Because if the company remains public and the public doesn't really see the full value of that company, then maybe it would be better to put that company private through an acquisition. And so right now, I do feel that this company is fairly undervalued, represents great value, especially in the next coming quarters, if not years. If the market suddenly notices the value of Build-A-Bear and the market sentiment changes overall, I do think that these stocks could be one of the outperforming ones in the coming years. Now, obviously, it's not yet in my personal portfolio. It will be in the channel's portfolio right after I post this video, but I'm seriously thinking of adding this into my personal portfolio as well. So stay tuned. You can follow me on Common Stock and Twitter to get some portfolio updates. But obviously, I would like to know your thoughts on this company. Have you actually looked at it? Have you been a customer? Let me know down in the comments below. If you enjoy this type of videos, give it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I'll see you all in the next one. Bye bye.